All right, in this video, I'm going to go over when you should be going break even in your trades. I had some people ask me, if I'm in a trade, should I go break even when a trade goes to one or after 20 points, after 30 points? And no, both of those are wrong. You shouldn't be having a specific time when you go break even every single trade. Every trade is different, and every trade has different reasons to go break even, if any at all. I have four main reasons why I personally go break even, and I've seen these help me the most during my trading and my students, my friends, and anyone else that I've taught trading. Going break even with these four reasons is going to help you the most, and I highly recommend you start inputting it into your trades. So the first one is obviously internal highs. What do I mean by internal highs? Let's say we entered a trade right here. Let's right here, stop loss here, and then let's say we had TP all the way at the swing high right here. So what do internal highs mean? Right here, highs that are not the swing high. So this high right here would be an internal high. This is a pretty bad example because we have this new week opening gap. Regardless, this is an internal high. So right here would be a valid spot to go break even. Why are internal highs valid spots to go break even? Because they have low resistance liquidity. What does that mean? Well, the swing highs have high resistance liquidity, which is why they're RTP. It's pretty much the biggest magnet, biggest magnet of price. And after that, you have low resistance liquidity. So potentially price could go to these internal highs, hit them, and then proceed to go lower. That's why I like having my TP at the swings. And then when we go to the low resistance highs, the internal highs, I like going break even because we could potentially reach there, take out the low resistance, and proceed the opposite direction and go back and hit our stop loss. That's why those are safe places to go break even. Let's show another quick example. Let's say you were entering longs right here off of this inverse, stops right here, TP at some high, let's say over here, or not even, you could say just TP right here. Where are potential break evens? Internal high, internal high. Both of these spots are potential break evens because they have low resistance liquidity. We could potentially reach these spots and go lower. So for example, this would have been a break even trade because look, we come here, we sweep out this low resistance, and we come back down, hit break even, and then proceed to hit full TP. Okay then, so what's the second reason why I would go break even? The second reason are unfilled fair value gaps. So when you're in a trade, there's a high likely chance that you have an unfilled fair value gap somewhere in the middle of that trade. And the high time frame for value gaps that are unfilled, like the 5 minute, 15, 30, 1 hour, even the 1 minute sometimes can cause, price to flip and go in the opposite direction. So once again, let's show an example. Like this previous trade. Say we enter here, stops here, TP here. We have a unfilled new week opening gap right here where there's a high liquidity pool because there are no orders there. Price was here, market open, price came down here. We had no chance to fill in orders here, meaning price wants to go back here ASAP before going lower or potentially inversing it and going higher. But the fact that the matter is price wants to go up here and we don't know if we want to reject off of it or keep on going higher. So what we can do, we can go break even, be safe, risk less, and that's why my break even would be here. As we see, it still hasn't hit break even. It could potentially run all the way. Let's find another quick example. There's not a lot of unfilled gaps that I can see on the 4 hour. Let's go down to the 1 hour. Okay, this is perfect. Say we enter off this inverse here. These are just makeup trades, just to show you the example. Okay, where do we have an unfilled fair value gap? Right here. What does that mean? As soon as price reaches there, I would move my stops to break even. Why? Because there are resting orders here need to be filled. After these orders are filled, there's a chance the market dumps back. So just to be safe, after we hit this spot, after we hit this liquidity pool, we could have dumped down. So we go break even just to guard our position. That's the second reason why I would go break even in a trade. What is the third reason? Swing highs and session highs if they're not your TP. So usually I have swing highs and session highs as my TP, as my take profit, because those are the highest magnets for price. As I mentioned earlier, price wants to go there the most, and after it goes there, it usually reverses or has a retrace. So definitely every swing high, for example, swing high, high liquidity pool because they have a new week opening gap, swing high, swing high. If any of these spots are in the middle of your trade, I highly recommend going break even. And I just deleted everything, which is perfect, but it doesn't really matter. And then next, obviously, are session highs. All right, and then my third reasoning, I accidentally deleted all the drawings, so you can't really see it, but regardless, the third reason why I would want to go break even are session highs. And the last reason was wicks, which is what I'm about to go over. So, the reason why session highs is a good place to go break even is because price usually likes to go to these session highs and then reverse lower. The main objective of every session is to take out another session high or low because there's resting orders there, there's resting liquidity there. And usually after we hit those highs or lows, we either consolidate or go the other way. Very rarely do we keep on going up. But let's say, for example, you're in a trade like this and you're targeting these Asia highs and you have London highs before that. Let's clear this up so it looks cleaner. You would want to go break even at these London highs because price, as you can see, takes it out, consolidates, and reverses the other way. That's just one example. This happens pretty much every single session. And then lastly, we have wicks. All right, so lastly, we have wicks, which is really simple. Why do you want to go break even when we have wicks? Because there's indecision in the market. Every time you see a wick, let's just go back in price. You see a wick to the upside here, we reverse lower. Big wicks to the downside, higher. Right here, we have 2 wicks to the downside. What can you expect? We go higher. Wicks, 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 higher. So let's say you're in a position to go, let's say you entered shorts here, and your price is right here, and you're in this trade, and you're seeing a wick here, consolidation, wick, wick. At this point, I would want to go break even just to protect my position because there's indecision. We don't want to go lower. And I know usually when there's a wick, indecision in the market, the candle was down here at one point. We did not have enough sellers to close down here, so we came back up here. Meaning what? We could potentially reverse. Meaning what? We want to protect our position, we lower our risk, and we go break even. Those are pretty much the four main things. So session highs, wicks, internal highs, unfilled gaps, and then also swing highs if those are not already your TP. But that's pretty much it. That's where you should be going break even.